Welcome to Level 3, Advanced. You have proven your discipline through the basics and intermediate structures. Now we pull back the curtain on the forces that actually move the markets. Today, we discuss the mechanisms that explain massive price spikes and institutional behavior. This is what professional traders watch every single day. Are you ready to enter the institutional laboratory? Let's begin Module 7. Lesson 1. The role of market makers. When you buy an option, someone must sell it to you. That someone is often a market maker. Their job is not to gamble, but to provide liquidity and ensure the market functions smoothly. But here is the secret. When traders buy massive amounts of options on stocks like the S&P 500 or Tesla, the market makers are left with a massive risk. To survive, they must hedge. Lesson 2. What is hedging? Hedging means risk reduction. If a market maker sells you 10,000 call options, they lose money if the stock goes up. To neutralize this, they buy the underlying stock. Imagine Tesla is rising. Every time someone buys a call, the market maker must buy Tesla shares to offset their risk. This buying pressure pushes the price even higher, creating a self-fulfilling prophecy. Have you ever seen a stock rally for no apparent reason? Often, it is the invisible hand of hedging. Lesson 3. What is gamma? Technically, gamma is the rate of change of delta, but at the market level, gamma is the accelerator. When options are near at the money, gamma becomes extremely large. This high gamma forces market makers to buy or sell shares at an explosive pace. It is the fuel that turns a small move into a market-moving event. Think of gamma as the sensitivity of the market maker's reaction. Lesson 4. What is a gamma squeeze? This occurs in 4 precise steps. 1. Traders buy massive amounts of out-of-the-money calls. 2. The price begins to rise. 3. Market makers are forced to buy stock rapidly to hedge. 4. This buying pushes the price even higher, forcing even more hedging. This cycle creates a vertical explosion in price. It is a feedback loop of pure buying power. Lesson 5. A famous example. During the 2021 GameStop short squeeze, the stock price went to the moon in a matter of days. While the short squeeze got the headlines, the gamma squeeze provided the engine. The sheer volume of cheap, out-of-the-money calls forced market makers to buy millions of shares, creating a move that almost broke the financial system. Can you name another recent stock that felt like a squeeze? Stocks like AMC or Bed Bath & Beyond followed a similar blueprint. Lesson 6. Options flow. Professional traders don't look at charts alone. They watch the flow. Options flow shows large institutional trades. If you see millions of dollars in premiums hitting NVIDIA calls at a specific strike, it indicates a strong institutional bias. Lesson 7. Open interest. This represents the total number of open contracts. High open interest at a specific strike, like 500 on SPY, acts as a magnet strike, where the price gravitates. It is a psychological and mathematical anchor for the market. Lesson 8. Max Pain Deep Dive. Max Pain is the price level at which the largest number of option buyers will lose their entire investment at expiration. Why does this happen? Think like a market maker. They want to settle the market where they pay out the least amount of money. This creates a powerful gravitational pull toward the max pain level, especially during the final hours of a monthly expiration. It is the ultimate transfer of wealth from option buyers back to the institutional sellers. Have you ever wondered why a stock closes right at a psychological level on Friday? It is often the max pain magnet at work. Lesson 9. Applying advanced info. A true professional doesn't trade on one indicator. They synthesize at the money gamma, open interest anchors, and real-time flow to build a high-probability roadmap of the market. This is how you move from guessing to knowing. Do you prefer to follow the chart or follow the smart money? The best results come from combining technical analysis with institutional positioning. Final exam, question 1. What is hedging? 5, 4, 3, 2, 1. The answer: reducing risk by taking an offsetting position. Question 2. What creates a gamma squeeze? 5, 4, 3, 2, 1. Rapid call buying forcing market maker hedging. Question 3. What does options flow show? 5, 4, 3, 2, 1. The answer is large institutional trades. Question 4. What is the primary incentive behind max pain? 5, 4, 3, 2, 1. To minimize payouts from institutional sellers to option buyers. Question 5. What is a magnet strike? 5, 4, 3, 2, 1. A level with high open interest where price tends to gravitate. Masterful performance. You have completed Module 7. You can now explain how options move the market, identify a gamma squeeze, and interpret institutional magnets. In our final module, Module 8, we build your complete professional trading system. We will cover hedge fund capital management and how to statistically verify your edge. This is where you become a true professional. See you in the final laboratory.